All right. Hi, guys. สวัสดีครับ Welcome to Redefine Tomorrow 2026. So my name is Thanawat Sutantiwarakun. I'm the CEO of Bitaza. So today the topic is very interesting, right? So we're in the scene where the institutions comes in, a lot of them. And now we would like to know how do we assess the risk and how do we build convictions on the topic of capital allocations in digital assets, how institutions assess risk and build convictions. And we will have today a guy who is perfectly suited for this topic from QCP Capital, a leading institutional digital asset trading firm, Eugene Kwok, business manager to founder and CIO and CEO of QCP Capital.
Hi, Thanawat. Thank you for having me. For those of you who have not encountered QCP, well, we're Asia's leading digital asset partner. We help investors all over the world with digital asset solutions. We do everything from on and off ramping to options, to structured products, to even treasury strategies. So yeah, I'm excited to speak with you today.
All right, cool. Yeah, let's cut it short. Let's start with the first questions, right? You have explained a little bit about QCP Capital, how you involved in regards to OTC, liquidity providing, structures, derivatives. But then could you please briefly introduce your role at QCP? What do you do? And and how do you think about like capital allocations today?
Right. So at QCP, I sit across the organization rather than inside a single product vertical. So I work closely with various teams across the firm, like sales, compliance, coverage traders, marketing, and basically watch over governance, operational risks, and new systems. So because QCP plays the role of a wide scope solution provider, my perspective today is really about how institutions engage with the entire digital asset ecosystem, not just trading, but onboarding, liquidity access, treasury management, derivatives. So you asked about allocation, right?
Yep.
Capital allocation. I think what's interesting today is that capital allocation into digital assets is no longer purely just a directional bet on Bitcoin or crypto prices. I think institutions increasingly look at it as emerging capital markets ecosystem with multiple layers of opportunity. So they see it as part of a broader scope of things, right? Like liquidity provision, they look at structured yield, treasury optimization. So if we look at the life cycle of adoption, right? I think the first sign that an institution is interested but hasn't yet built conviction is usually in how they frame the question, right? They ask, how do we get exposure rather than how do we manage the exposure? So I think that distinction matters a lot. I mean, curious institutions usually focus on headlines and upside, right? But convicted institutions usually focus more on operational resilience, liquidity under stress, counterparty frameworks. I think this is something that we at QCP, and I'm sure at Bitaza, you guys have been continually like obsessed with, right?
Definitely. So, especially when we handle a lot of funds from clients.
Yeah, I think one anecdote that I've seen repeatedly is that many institutions, they arrive through a single asset like Bitcoin, but they stay because they discover the sophistication of the market structure. They stay because they discover options markets, basis trades, structured products. So I think that's where the conversation becomes more institutional rather than thematic.
Yeah, totally agree. Yeah. You can see a lot of people, I'm sure you have met a fair bit of people in the traditional space, in institutions where they want to adopt into digital assets. They have been talking a lot about it, but haven't really allocated serious capital into it. In practice, what do you think is the real gating questions before seriously allocating that big capital into digital assets?
Wow. I think 5 years ago, a lot of the institutions asked questions like, can we access crypto safely, right? But I think today the question has evolved. I think it's more about, can we explain this risk internally in a language that our investment committee actually understands? So in the
Mm,
last couple of years, crypto infrastructure has evolved quite a bit. And I think the real gating factor is no longer technology, it's about
mm,
institutional coherence. So by that I mean the questions that they ask is, for example, can the CIO explain the portfolio role? Can the risk teams model the stress scenarios? Can operational teams support booking, settlements, and custody? And even can compliance teams understand counterparties? So I think serious capital moves right when all these factors align. So
mm,
yeah, I think also interestingly, liquidity confidence has improved dramatically. I mean, when we look at Bitcoin, right, it's now liquid enough that in normal conditions, to be treated as a macro product and to rival many traditional macro instruments. But I'm not
mm,
sure if whether they ask further questions about the assets classification, right? So I don't know, do they see, I don't, maybe you can tell me, like, do they struggle with seeing classifying crypto as a macro asset, a technology exposure? Is it a volatility asset, a new commodity? So I think when they can answer all those questions internally, then
mhm,
allocation sizes tend to remain a bit constrained, right? But I think that the institutions moving fastest today are not necessarily like the most aggressive. They're just the ones with the
mm.
clearest governance process, I think.
Right, right, right. So since I guess you have faced a lot of like family offices or financial institutions, right? What are the assets they're looking to allocate? Like the first few ones.
Wow, the first few ones, I think a lot of them, well, they start with the majors, right? I think the way that people look at Bitcoin has changed in the last couple of years. People see it as more than just a hedge against inflation.
Yep.
Um, you see more venues accepting Bitcoin as collateral. You see more. I mean, QCB is one of them where we can help you earn yield from Bitcoin. So I think that's where people usually start. Um, and yeah, we're talking about major institutions here. So I don't think that
Yep.
I don't see anything that moves away from the majors, basically.
Mm. Yeah, I do agree with that because they gotta fit in their risk assessment frameworks and everything, right?
Exactly. Mm-hmm.
Mm. Yeah, and I guess given you guys are also an expert in structured products, there are these products that have like a low drawdown these days. Because in the end, I kind of feel that I'm not sure whether you agree. I kind of feel that those like very traditional institutions, right? They tend to see even Bitcoin with such high market cap, right? It's still very, very volatile assets, and it's too risky to actually put in the mandate.
You're right. I think, but sometimes when they talk about it that way, I feel that the biggest confusion is between volatility and fragility, right? So you talked about
Mm,
Bitcoin being volatile, right? So an
mm.
asset can be volatile without being structurally fragile, right? So I mean, Bitcoin has huge like liquidity depth. Its settlement certainty, its market resilience today is much stronger than many people realize.
It's
So
top 10
I mean,
market cap in the world.
yeah, yeah. And then on some hands, right, on other hand, some exposures that may appear stable can actually carry hidden structural liquidity risks, right? So yeah, I think we're probably going to talk about this later, but I think one thing that we see at QCP is that risk is multidimensional, right?
Mm. Yep, yep, yep. Yeah. So since we are talking about risk, right? Yeah, from your perspective, where do these institutions most often fail to distinguish like between these risks, like price, liquidity, structural, and operating risks?
Well, I think institutions sometimes they underestimate things like concentration risk, exchange dependency. I think you can't see risk as like in one basket, right? It
Mm,
needs to be a more nuanced view. So I mean, it's like a directional position might be hedged perfectly, but it might be operationally weak, So
Mm,
I think it's quite hard because traditional finance, right? They learn these lessons across decades, but
mm,
digital assets, they're compressing them into a much shorter time frame.
mm. True, true, true. I do agree. Um, do you think in terms of institutional, when they assess digital assets, like in comparison between the last cycle and these cycles, do you see a lot of changes, and where do you see the changes? Because right now, a lot of people actually talk about like, stable coins, RWAs, there's Cannon Chain where DTCC comes into play,
Right.
Goldman Sachs come into play, right? Yeah, where do you see the chain and differences between these two cycles?
Okay, so you're asking me from a risk assessment view, right? So
Yep.
I'll get disclaimer, I'm not in QCP's risk department, but I'll give my take. Okay. I think a big change I
Yep.
see is that institutions now separate the asset risk from infrastructure risk. So in the last cycle, right, like we were talking about, many investors, they treated it all as one blended category. So what I mean is, if Bitcoin price falls, or if an exchange failed, or if a stablecoin depegged, everything just became crypto risk, right? So,
Mm,
but today the market is more nuanced, right? So, a lot of institutions, and certainly us as well, we increasingly distinguish between price volatility, counterparty risk, custody risk,
mm,
liquidity risk, regulatory risk, right? So, I mean, and also some risks that dominated headlines previously, they matter less now. For example, last time the question used to be, will crypto survive? But after
exactly.
after ETFs, major banks entering the space, sovereign engagement, and I think we've also seen clearer regulatory frameworks, in jurisdictions like Singapore and the UAE, and increasingly the US. So that existential question has kind of faded. So I think what matters more now is implementation quality. So institutions are asking, who is the counterparty? What happens during stress? How quickly can the risk be unwound? I think it's a much more mature conversation now as opposed to
Mm,
previously. So I think in many ways, digital assets are becoming less ideological and more operational, if you will.
more operational. Yeah, I totally agree. Yeah, a lot of things has changed over the past only couple of years. Like with the views after it's really happened after like the announcement of the ETF by the US, right? And now there's Genius app and about to have Clarity. So yeah, so it's inevitable to actually adopt to it. So I think right now it's also inevitable. Like in institutions may have to try to move from observation to allocations. So where do you think like the hardest internal debate usually happens?
Wow, hardest internal debate. I think
Mm,
like we're talking about, right? The conversation is no longer around, should we look at digital assets, right? I think for many institutions, it's been moved from nice to have to core to have, and
mm,
at least in their roadmap. And more importantly, it's how do we operationalize these exposure properly. So I think the hardest debate, right? It's usually around accountability. You ask tough questions, right? Like before allocation, how much risk are we actually willing to own? How do we defend this allocation against volatility, right? And actually, if markets dislocate, who is actually responsible, right? Because when you look at an institution allocating, they are usually
mm.
built around process consistency. They can scale it up. They have a framework, right? They can do it again and again, right? And it's
Yep.
tight. But sometimes crypto challenges that because the market evolves extremely quickly. So I think when you talk about the internal debates, right?
Mm,
One thing that I realized while working here is the investment case to allocate and invest is always way easier, right, than building a governance framework.
mm.
So I mean, you talk about the implementation layer that is often underestimated. I'm sure you know this as well because you've been through building the company, right? Like the layer that's often underestimated is things like custody, okay, collateral mobility. What is the accounting treatment to these investments? Um,
Definitely.
yeah, it's like onboarding with Rails, treasury workflows. So these operational details, they often determine whether an institution can scale from a small exploratory position to a bigger sort of strategic allocation. So I think the debate will be around these questions.
Mm. Yeah. Operations is always a big debate. And there's so many variables which can go wrong. So
Yeah, exactly.
totally agree. Face that myself. But how about in the question of, let's say, for example, a big institutions, right, with large amount of money and a lot of diversification for the assets. And when they go into like investment committee, and if the question asks like how large the position should be, like, do you think there will be a lot of like debates on that as well, given that different people have different perspective, right?
Right.
On risk and return, and also whether or not this is too big or this is too small. It's quite subjective to a certain extent.
Of course. I think sizing is, sizing is specific to every institution, right? Everyone will have a different view. Everyone will have a different narrative. Maybe I think the thing that you're getting to, right, is do we act early, or do we wait for all the evidence? Um, because that also determines the size, right?
Yep.
Yeah, I don't know. It's always a balance, right? There's timing risk and thesis risk. If you wait for perfect clarity, do you know how everybody is always willing to size when they have perfect clarity, right? But then the opportunity usually repriced already.
It's just gone already.
Yeah, exactly. So if you move too early without sufficient underwriting, like volatility can force you out before the thesis matures, right? So
Yep.
I think that the institutions that navigate this well, they scale progressively. So they don't jump immediately from zero to like full allocation, right? So I think we talked a lot about operations, right? I think they build operational familiarity for us. They understand liquidity, they have proper risk frameworks, they build all this and internal confidence over time, right? So I think we know that in crypto, right, and digital assets, surviving volatility is more important and matters more than perfect timing. So I think one thing we've learned QCP also, and then we've seen, is that institutions, they rarely regret starting too small. They often regret sizing too aggressively before the governance maturity catches up.
Mm. All right. Makes sense. Um, so yes, since QCP sits close to both trading reality and investor behaviors, right? What is the first sign that market attention is outrunning real convictions?
Wow. Uh, I think I think when flows become narrative driven, and
Mm.
and hedging activity doesn't increase proportionately. So yeah, I mean we talked about a lot about risk, right? And real
Yep.
conviction usually comes with risk management. So I think institutions, right, with exposure, think about they think about it as a whole, right? So okay, let's think about when markets become purely momentum driven. What happens? We
Mm.
see leverage rising quickly. We see shorter holding periods. Concentrated positioning. We see like slight reduced focus on fundamentals, right?
Mm-hmm.
And and I think another sign that it's outrunning conviction is when everyone talks about price targets, but nobody talks about implementation mechanics.
Yep.
So so I think mature institutional participation, right, tends to sound a lot more operational. Lah. Speculative participation is they tend to sound a little bit more emotional, right?
Understood. All right. So when everyone talks about it and talks about speculating and have like such a far-fetched price target, I would say, right?
Yeah.
Got it. So next up, in digital assets, speed can create opportunity, but it can also punish weak underwritings. How do you think about the trade-off between acting early and demanding enough evidence before? Oh, actually, we went through this already
Oh
a
yeah,
little bit.
we spoke about that. Yeah, it's a balance between the two. And
Yeah.
yeah, I think it will really sound more operational because when when you act early, people always people always tend to have more. Um, I mean, yeah, it's a tough spot because also everybody has a different view, right? And it's not simple. It's not a straightforward answer, basically.
It's definitely not. Mm. And but now since everyone is talking about stable coins narrative, do you think this would actually trigger more adoptions from like the traditional institutions since it's not really a speculative assets narrative, right? It's more on the um, you know cross-border settlements, remittances, things like that.
I
Yeah.
think
So
we can see the evidence already. There's so many banks that are dealing with stablecoins and are offering and having that product offering to their clients, right? And I think stablecoins are where you're right, they have monetary mobility where people see the true utility and can experience it. So I mean, there's a lot of of benefits, right? So as banks and major institutions are adopting it, I think
mhm.
it's like what we talked about. The governance frameworks has to catch up.
Mm.
So I think as everything matures, right? Yeah, we'll definitely see more adoption.
All right. Yeah, totally agree on that. So, like we have been talking a lot about risk, and I think you emphasize a lot on operations, especially for institutions, right? You need to understand
Mm-hmm.
like this and that. So, so in terms of, let's say, a new institutions want to, allocate some capital into digital assets and know nothing about it. Do you think operations still the first thing that they have to understand first before building like convictions into digital assets?
I mean, we should invest in things that we know, right? But if you're asking me about the process, I think from
Yep.
where I sit, right, I would say that governance and execution discipline is just the most important thing. And and the reason I say this because markets can forgive imperfect timing, right? But they rarely forgive weak processes, especially at an institutional scale, however small. I mean, if an institution wants to have durable conviction, right, they need to move right from the enthusiasm to having repeatable frameworks. So I
Hmm.
mean, investment committee alignment, like liquidity protocols, there's counterparty diversification, there's all these things that they just need to line up, right? And and most people might not see it this way because in TradFi, this infrastructure maturity, right, is often invisible because it already exists. It forms the structure of the institution, so it's quite invisible to most people. But most of the time in digital assets, the institutions are building all these in real time. And I'm sure
Mm.
you can vouch for this too. Like, yeah, we'll build because it evolves so fast. There's new tokens, there's new regulatory requirements, and we are just building the governance process in real time. So I think the firms that succeed long term, right, are usually the ones that treat digital assets as part of an enterprise-wide risk management rather than a standalone trading experiment. They can't see it just as a special project anymore. They got to see it. How does it integrate? With the entire firm.
Mm. I totally agree with that. It's as you mentioned before many times, right? It's no longer a speculative asset. It's rather a tool, which in the end, I guess blockchain it's a technologies in which it helps and supports and enhance whatever productivity efficiencies for the company itself. Is whether or not you're going to adopt to it or not, right? But if
Yeah,
others adopting to it, then you might be lag behind.
exactly.
Mm. But then I think even now, right? A lot of people speak about it. There are a lot of meteors. You can get a lot of research and research papers to read about like digital assets and even risk and stuff like that. I think there's still a fair bit of misunderstanding, still overestimating on things, underestimating on things. So from your experience, where do you see like all these institutions still overestimating the risk in the digital assets, and where do you see they still underestimating those risks?
Oh, I think it's what we said, right? I think they overestimate the existential risk and they underestimate the operational complexity, right? So remember we talked about how most institutions they still think in, or rather some of them they still think in binary terms, right? Will crypto survive or fail? But I think that
Mm.
question is like getting increasingly outdated, right? Because
Mm, I
the
think so.
ecosystem now is too integrated into global capital markets to dismiss entirely. So I think what's underestimated, right, is how resilient operationally is the firm, right? We talk about like cross venue risk, governance during market stress. How do they handle collateral management? So I think also, well, institutions can also sometimes underestimate how quickly liquidity conditions can change in digital assets because the markets trade constantly, right? There's no closing bell. So I think risk management therefore becomes a 24-hour discipline rather than a market hours discipline. So yeah, I think that's where they overestimate and underestimate some risk.
Mm, okay. It's to add on in terms of risk. Want to hear your perspective on the over leveraging risk, because right now, especially for digital assets, right? There are both DeFi and even CeFi that allows a lot of leverages and a lot of retail, even corporate, or even some of the institutions. A lot of institutions actually do leverage a lot, no matter is the long positions or the short positions, right? Which it's also led to the incident during 1010 2025 as well. Um,
Yeah.
yeah, what's your perspective in regards to that risk on an ongoing basis or the near to medium futures?
Wow, it's hard to comment. I think it's something that it has been quite embedded in the space, right? Crypto is always going to be a highly leveraged space.
Hassle waving. Yep.
Yeah. So I think like for us as a firm, because we're regulated, we don't do anything with DeFi. Um, we we don't do anything with yeah, we don't leverage, our clients can't leverage. We I think the risk department needs to we look at it like I mentioned, it's multidimensional. So we have to handle we stay away from all those scenarios lah, basically. And I think
Mm,
yeah, the firm has made quite important decisions in the years for us to have survived like almost every market cycle, right? So I think it's accepting it and knowing that it's going to be part of the space. And how does your institution have the necessary frameworks, right, to deal with that risk?
mm. That's a great risk assessment, actually. Yeah, as long as you don't leverage too much or no leverage at all, you could save yourself a fair bit. Right. So, how like looking ahead like 12 months, what would convince you that institutional convictions in digital asset is becoming deeper and more durable rather than just like more visible, more attentions? Yeah.
Wow, next 12 months, what would convince me that institutional conviction is becoming deeper. I think
Yeah,
I will
becoming
look
real.
Yeah, I think I will look less at headline inflows and more at behavior during stress. Now's kind of a good time, right? Our asset class isn't doing too well. I think
Yeah,
institutions having
true.
more, yeah, I think they them having more durable conviction is visible when they let's see they maintain allocations during volatility. They hedge systematically rather than panic. Sometimes I look at institutions and if I see them expanding operational infrastructure, then I can see their conviction becoming deeper. You can also see some institutions diversifying their strategies, and they're integrating their crypto assets more into long-term portfolio construction. So it's not just one thing, right? Like we are all preparing for a cross asset wealth. So when you see that the digital assets sit in their portfolio and it's part of a longer term strategy integrating with different asset classes. So yeah, I think another strong signal would be maybe broader adoption beyond just simple directional exposure. So things like we'll see more treasury use cases. We see more options overlays. See more institutions getting into structured products like yourself.
Yep.
And there's more like collateral optimization, and really cross asset portfolio integration. I think when you look at all these things, you can see how the conviction is deeper, right? And it's more enduring. It's not so hype based, right?
Mm,
Yeah, and I think you're right. I think the real institutionalization of digital assets happen when crypto really stops being treated like a special project now, and
mm.
they see it fitting a piece of the puzzle, or or like a weapon in the arsenal, right? For a wider capital markets vertical. So I think,
Mhm.
but I do think that's a direction that we increasingly see today.
Okay. Actually, I'm also curious and want to hear your perspective on RWAs, right? Because right now it's also another narrative and topics that pretty much everyone's talking about whenever you go to events here and there, especially I would say in Southeast Asia. A lot of people are talking about like real world asset. You tokenize the real business. You could tokenize the yacht. You tokenize real estates and things like that, right? However, there's still a lot of risks within these RWA tokens because of the liquidity issues and the fact that the market makers don't usually take position of these assets because the underlying asset is not that liquid, even though the token itself is liquid, right? So you could be stuck with certain price which you don't have the exit liquidity. Just would like to know like your perspective on those kind of liquidity risks from RWA, even though it has been, pretty much a talk of the town in many events.
Wow. Uh, yeah, RWAs has been the talk of the town for a while. I'm not by any means an expert on RWAs. I mean,
Yeah.
we understand that it has a lot of risks, a lot of problems. They've got problems with standards. They've got problems with. I'm sure there's a lot of legal problems that hasn't really surfaced yet. And you're right when you mentioned the liquidity. It's really often overstated. And also when they talk about how tokenization always unlocks liquidity, I think that that's exaggerated. Because you tokenize an illiquid asset, right? It doesn't automatically create buyers, right?
Yep.
So
Exactly.
yeah, they might have limited buyers. They might have even like transfer restrictions depending on the asset. There's no active market makers. So I don't know. I think we're still really early there. I think as much as it's been a talk of the town because people can see the value and the utility of the technology, right? But I think I think we're still early.
Right. Okay. Um, I think we have a little bit of time left. I'll just go with like the last questions in my mind. Is that since right now we can see a lot of progress and a lot of hype in terms of structural and regulations progress in the US and even in Europe, right? MiCA is out and it's all EU pan. US is working on like Clarity Acts to segregate into who is responsible to who can issue and things like that as well, right? How do you think the regulations and structural frameworks for Southeast Asia in order to enhance digital asset industry, especially for institutionals in maybe Southeast Asia or Asia? What's your perspective on that?
I think Asia has been great, right? Like we've got so QCP is regulated in Singapore as well as in Abu Dhabi. And I think we've seen that the regulations here and there have been very progressive.
Mhm.
Yeah, they've been very they want to grow the industry, right? They're concerned with innovation, So I think it's always been great for us in Asia, where there's a lot of activity. I think we also obviously we also see a lot of movement in the US as well. So to me, right, when I look at the whole the whole map, in the world, I only see progress.
Mhm.
So then the question is this, right? Everyone is chasing the new thing, right? AI, and crypto suddenly right now doesn't seem like the most exciting thing, but that's when people build. So that's when regulators build, that's when institutions build, that's when all the people who are concerned with technology build.
Mm.
And I think like we framed this whole conversation well, right? I think we can see that institutions do not allocate because they are excited, they allocate because they can explain the risk. So that involves regulatory risk as well, right? And once everything comes together, yeah, I do believe that we'll see a lot of evolution in the space, and I think it'll be exciting for us.
That's cool. I totally agree with you in terms of activities. I just feel maybe it's a personal views, right? I just feel that regulations doesn't catch up with the builders and even the corporates, the adoptions in Asia. The adoption activities is very fast, and we are among the top 10 contenders, of course, in terms of adopters in Asia. Here, it's just that the regulation framework that doesn't really catch up with the activities progress. That's all.
Yeah, that's always the case, right? We always things always moves faster, and then they try and catch up. But I think from what I've seen, at least in Singapore and Abu Dhabi, that they've been quite progressive, and I think they've been quite they see the future in it. And but yeah, I think it'll be hard, right? Innovation in our world always moves so much faster than theirs, right?
Definitely, definitely. All right. Thank you very much, Eugene. And thanks,
Thanks, Dana.
Redefine Tomorrow. Again, thanks very much. Bye bye.
Thank you. Thanks, Dana. Nice chatting.
Nice.